Across America, millions of individuals are losing significant portions of their hard-earned money, not to high tax rates, but to something far more insidious: widespread tax myths. These aren't obscure loopholes or complex legal battles. They are simple, often well-intentioned misconceptions that permeate everyday financial thinking. For many, these myths act like a silent erosion, chipping away at savings, stifling growth, and, in some cases, leading to severe financial distress. We are not just talking about minor errors. We are examining fundamental misunderstandings with profound, real-world consequences for ordinary people. Consider Maria, a talented graphic designer who started freelancing on the side to save for her daughter's college fund. She believed, like many, that small, irregular payments didn't need to be immediately reported to the IRS unless a 1099 form arrived. This seemingly minor misunderstanding would cost her dearly. For months, she diligently tucked away her earnings, unaware that every dollar, regardless of its source or amount, is taxable income. This isn't an isolated incident. It's a pervasive belief that traps countless individuals in the burgeoning gig economy. The central myth Maria fell prey to is the belief that small income or cash under the table goes unnoticed by tax authorities. It suggests a certain anonymity in microtransactions. However, according to financial analysts, this couldn't be further from the truth. Digital payment platforms, banks, and even cash transactions through certain business models leave trails. The IRS maintains a robust data matching system, cross-referencing information from various sources. Believing small income is untraceable is akin to thinking a single raindrop won't contribute to a flood. The IRS leverages sophisticated data matching programs. They receive copies of forms like W-2s, 1099 NECs, 1099-KS, and now even forms from third-party payment networks such as PayPal and Venmo above certain thresholds. The agency then compares these documents to what individuals report on their tax returns. Any discrepancy triggers an inquiry, states former IRS agent Mark Johnson in a 2023 interview for Tax Insights Monthly. This means even small unreported amounts can flag an account, leading to letters, audits, and potentially significant penalties for taxpayers who thought they were flying under the radar. For Maria, her side gig generated about $7,000 in a year through various small projects, none individually reaching the $1,099K threshold then in effect. She meticulously saved this money, believing it would only become official once a formal document arrived. When tax season came, she simply filed her W-2 from her main job. Months later, a letter arrived, an IRS notice for unreported income. The agency had cross-referenced her bank deposits and identified income that didn't appear on her return. The resulting penalties and interest quickly inflated the initial tax liability. The tax on Maria's $7,000 was manageable, perhaps a few $100s. However, the penalties and interest significantly escalated the bill. The IRS typically charges an accuracy-related penalty of 20% on underpayments due to negligence or disregard of rules. Added to this are interest charges, which accrue from the tax due date until paid. For Maria, a few $100s in taxes became over $1,000 in total debt, wiping out a significant chunk of her savings for her daughter's college fund. It was a harsh lesson, learned through the painful experience of financial setback. Another deeply entrenched myth, one that often brings a false sense of security, is the idea that only the rich get audited. Many believe their modest income or uncomplicated returns make them invisible to the IRS. This myth suggests that the agency focuses solely on high-net-worth individuals, large corporations, and complex offshore accounts. While these groups certainly face scrutiny, the reality reveals a different, more nuanced, and often more painful picture for those at the lower end of the income spectrum. This misconception leaves many vulnerable, unprepared for potential IRS inquiries. According to a 2023 report from Syracuse University's Transactional Records Access Clearinghouse, TRAC, taxpayers claiming the Earned Income Tax Credit, or EITC, are audited at significantly higher rates than nearly any other group. The EITC, designed to support low to moderate income working families, is unfortunately a common target for IRS scrutiny. While the IRS states that these audits are crucial to combat fraud, critics argue the burden disproportionately falls on those least equipped to handle complex tax examinations. This creates immense stress for vulnerable populations. Let's examine the numbers. While taxpayers earning over $1 million face a 1% audit rate, those earning under $25,000 and claiming the EITC can face rates as high as 1.7% to 2.3%, according to track data from 2023. This means a low-income family is statistically more likely to be audited than a millionaire. The sheer volume of EITC claims, combined with the complexities of eligibility, makes it a fertile ground for IRS verification efforts. This challenges the popular perception that the agency exclusively chases high-value targets. Meet James, a single father working 2 part-time jobs, earning just enough to qualify for the EITC. He relied on a free tax preparation service, believing they would handle everything correctly. A year later, James received a CP 2000 notice, followed by an audit letter questioning his EITC claim. The IRS wanted proof of residency for his child and detailed income documentation from both jobs. James, overwhelmed and lacking organized records, found himself in a bureaucratic nightmare. The stress impacted his ability to focus at work and his family life, purely due to a claim intended to help him. For James, the audit wasn't just a financial challenge, it was an emotional ordeal. He spent countless hours gathering documents, making phone calls, and dealing with anxiety. The process, even if eventually resolved in his favor, felt like a punishment for seeking a legitimate credit. A study by the Taxpayer Advocate Service in 2021 highlighted the disproportionate stress and burden placed on low-income taxpayers during audits, often leading to mental health issues and lost wages due to time spent responding. This dispels the myth that audits are merely inconvenient for the wealthy. For many, they are genuinely devastating. Small business owners and freelancers often fall victim to another pervasive myth, the belief that anything related to my business is a tax deduction. This myth suggests a blanket permission to write off expenses, from personal travel disguised as business trips to lavish meals. While the tax code offers legitimate deductions to reduce taxable income, it's far from a free pass. This misunderstanding can lead to aggressive, unfounded deductions that, when scrutinized, result in disallowances, penalties, and even accusations of tax evasion. It's a costly gamble for many entrepreneurs. The IRS provides clear guidelines for what constitutes a legitimate business expense. It must be both ordinary and necessary. An ordinary expense is common and accepted in your industry. A necessary expense is helpful and appropriate for your business. It doesn't have to be indispensable. Tax professionals like David Jones, author of Small Business Tax Hacks, emphasize that documentation is key. If you can't prove it, it's not a deduction, Jones states. This strict interpretation means that a lavish party for clients might be ordinary in some industries, but if lacking direct business purpose, it won't be necessary. Let's compare. A legitimate deduction for a freelance writer might be the cost of a new laptop, industry-specific software, or professional development courses. These are clearly ordinary and necessary. An aggressive, and likely disallowed, deduction might be claiming a personal vacation to Hawaii as a business conference, with only a vague connection to networking. Or deducting the full cost of a personal vehicle, despite only using it 10% for business. The line is often blurred by hope rather than fact, costing business owners thousands in disallowances and penalties. Alex, a new consultant, proudly told friends he wrote off everything from his home office furniture to his daily coffee runs and even a new wardrobe, convinced it was all part of building his brand. His initial tax return showed a surprisingly low taxable income due to these extensive deductions. However, a random audit flagged his Schedule C. The IRS agent meticulously went through his receipts, disallowing several $1,000s in expenses deemed personal or lacking sufficient business purpose. Alex was forced to pay back taxes, penalties, and interest, setting his new business back significantly. The penalties for substantially understating income can be severe. If the understatement is more than 10% of the tax required to be shown on the return, or $5,000, whichever is greater, a 20% penalty on the underpayment applies. For Alex, these penalties, combined with back taxes and interest, amounted to over $4,000, a sum he hadn't budgeted for. It illustrated a critical point. While maximizing deductions is a savvy financial move, crossing the line into unsubstantiated or personal expenses is a costly mistake. The initial savings evaporated, replaced by debt and stress. Perhaps one of the most celebrated, yet misunderstood, tax outcomes is the large refund. For many, receiving a hefty check from the government feels like winning the lottery, a sign of successful tax planning, or even a bonus. This pervasive myth leads people to intentionally overwithhold taxes throughout the year, celebrating the refund as a windfall. However, financial experts consistently argue that a large refund is not a sign of smart financial strategy. It's often the opposite. It represents lost opportunities and an interest-free loan to the government. When you receive a large tax refund, it means you paid too much tax out of each paycheck throughout the year. Essentially, you gave the government an interest-free loan. That money could have been earning interest for you in a high-yield savings account, invested in the market, or used to pay down high-interest debt, explains financial planner Sarah Chen in her 2022 blog post Optimizing Your Withholding. Instead, it's sat idle. For an average refund of nearly $3,000, that's $3,000 that wasn't working for you for up to 15 months. Let's quantify this opportunity cost. If an average taxpayer received a $3,000 refund, and that money had been invested over the year at a modest 7% annual return, it could have generated approximately $210 in additional wealth. While $210 might not seem like a fortune, it's money that was simply given away for free. Over multiple years, these lost gains compound. This passive financial leak prevents many from building emergency funds, paying down debt efficiently, or making strategic investments that could significantly improve their long-term financial health. Some argue that a large refund acts as a forced savings plan for those who struggle to save voluntarily. While this perspective holds a kernel of truth for certain individuals, it overlooks the fundamental principle of financial empowerment. Relying on an annual refund rather than disciplined saving limits financial flexibility and control. It's better to have consistent access to your money throughout the year to manage cash flow, react to emergencies, or seize investment opportunities, advises the Consumer Financial Protection Bureau in a 2023 guide on smart money management. Instead of waiting for a large refund, the savvy approach is to adjust your W-4 form with your employer to ensure your withholding closely matches your actual tax liability. This puts more money in your paychecks throughout the year, providing greater control over your finances. Financial literacy advocates suggest reviewing your W-4 annually, especially after major life changes like marriage, divorce, or having children. This simple adjustment can transform an annual windfall into consistent financial resilience, allowing your money to serve you better. As tax deadlines approach, many taxpayers, feeling overwhelmed or unprepared, opt to file an extension. A common and costly myth associated with this is the belief that filing an extension also delays your payment deadline. This provides a false sense of relief, leading people to believe they have several extra months to not only file their return but also settle their tax bill. This misunderstanding has severe financial repercussions, as payment delays incur interest and penalties, quickly inflating the original tax liability. It's a classic case of delaying gratification turning into financial regret. The reality, as clearly stated by the IRS, is that an extension of time to file your return does not grant you any extension of time to pay your taxes. When you file Form 4868, you are merely extending the deadline for submitting your tax forms, typically until October 15th. However, any estimated tax owed is still due by the original April deadline. If you don't pay by April, you'll be charged interest on the unpaid amount, plus a failure to pay penalty. This crucial distinction is often overlooked, turning a simple filing deferral into a compound financial burden. Let's look at the financial consequences. The failure to pay penalty is typically 0.5% of the unpaid taxes for each month or part of a month that taxes remain unpaid, capped at 25% of your unpaid tax bill. On top of this, interest accrues on unpaid taxes and penalties, compounding daily. The annual interest rate for underpayments is determined quarterly and can fluctuate, but generally sits around the federal short-term rate plus 3 percentage points. These rates quickly add up, transforming a small estimated tax bill into a substantially larger one over just a few months. Sarah, a self-employed artist, filed an extension in April, estimating she'd owe around $2,000. She planned to pay it once her finances stabilized in a few months. When October arrived, her $2,000 tax bill had silently grown. By then, she owed nearly $2,150, an extra $150 purely due to penalties and interest. This might seem small, But for an artist managing tight cash flow, $150 is significant. It meant delaying a purchase of much-needed art supplies or pushing back a crucial bill payment. Her initial relief at filing an extension morphed into financial strain and regret. To avoid Sarah's predicament, it's crucial to accurately estimate your tax liability and pay it by the April deadline, even if you file an extension. The IRS provides tools and worksheets, like Form 1040-ES, Estimated Tax for Individuals, to help with this calculation. If you genuinely can't pay the full amount, paying as much as you can will reduce penalties. The IRS also offers payment plans, like an offer in compromise or an installment agreement, but these still accrue interest. Proactive estimation and payment are key to preventing unnecessary costs. In the digital age, many taxpayers rely heavily on tax preparation software, believing it to be infallible. The myth is that these programs are so advanced they will automatically catch everything, optimize deductions, and prevent errors, regardless of the input. This belief grants a false sense of security, encouraging users to input data without thorough review or understanding. While tax software is powerful and highly useful, it is ultimately a tool. Its accuracy and effectiveness are directly dependent on the information and understanding of the person using it. Garbage in, garbage out is a fundamental principle in computing, and it applies directly to tax software. If you input incorrect income figures, misclaiming legitimate deductions, or misclassify expenses, the software will process these errors and produce an inaccurate return. The software can only ask the questions. It can't verify the truth or completeness of your answers, explains tax preparer Maria Rodriguez in a 2023 online seminar. This means user error remains a significant cause of tax mistakes, even with the most sophisticated programs. Common pitfalls include failing to report all income sources, especially from gig work or investments not generating 1099s. Another frequent error is misclassifying personal expenses as business deductions, assuming the software will know better. Taxpayers might also overlook important tax credits because they don't fully understand their eligibility or answer prompts incorrectly. For example, the child and dependent care credit, often missed by eligible families, can be overlooked if specific questions aren't answered with proper understanding. The software won't magically invent missing data or correct misunderstandings. David, confident in his tax software, quickly entered his W-2 and a few expense totals, hitting submit. He received a small refund. Months later, he discovered he'd overlooked a significant home office deduction he qualified for, and failed to report a small amount of cryptocurrency gains he thought were too minor to matter. A professional review revealed he could have received an additional $800 refund from the deduction and avoided a potential notice for the crypto income. The software didn't highlight these. It only processed what he provided, costing him money and creating future risk. These individual stories of Maria, James, Alex, Sarah, and David are not isolated incidents. They represent a collective erosion of wealth and financial stability across society, fueled by widespread tax myths. When millions fall prey to these misconceptions, the cumulative cost is staggering. It leads to billions of dollars in unnecessary penalties, lost investment opportunities, and forfeited savings each year. This isn't just about individual mistakes. It's about a systemic vulnerability where misinformation directly translates into economic disadvantage for everyday citizens. The numbers reinforce this. In 2022, the IRS assessed over $31.3 billion in penalties. While not all are due to myth-driven errors, a significant portion stems from preventable mistakes like underpayment, late filing, and inaccurate reporting. A report by the National Taxpayer Advocate estimated that a substantial percentage of these penalties could be abated if taxpayers had a better understanding of their obligations and avoided common misconceptions. This $31.3 billion is money that could have remained in the hands of taxpayers, fueling local economies, or providing financial security. Why do these myths persist? Experts point to a significant knowledge gap in tax literacy. Formal tax education is rarely compulsory, leaving many to learn through anecdotal advice, outdated assumptions, or trial and error. The complexity of the tax code further exacerbates this issue, making it difficult for average citizens to distinguish fact from fiction. We need to shift from reactive enforcement to proactive education, argues Dr. Emily Roberts, a tax policy researcher at Georgetown University in a 2023 policy brief. Closing this gap is critical for empowering taxpayers. The difference between a reactive and proactive approach to taxes is stark. A reactive approach often involves panic at tax time, rushing to meet deadlines, and hoping for the best. This is where myths thrive, leading to errors, audits, and penalties. A proactive approach, however, involves understanding basic tax principles throughout the year, keeping meticulous records, and seeking advice before issues arise. The reactive taxpayer often pays more in the long run, while the proactive taxpayer gains financial control and peace of mind. The real lesson from these common tax myths is clear. Knowledge is power, and diligence is your shield. Taking control of your tax situation isn't about becoming an expert tax accountant. It's about understanding fundamental principles, recognizing common pitfalls, and knowing when to seek professional help. It's about shifting from passive acceptance of myths to active engagement with your financial reality. This empowered approach can save you thousands of dollars, countless hours of stress, and open doors to genuine financial growth. First, educate yourself. Utilize credible resources like the IRS website, which offers free publications, guides, and tax tips. Many reputable financial news outlets and non-profit organizations also provide clear, accessible explanations of tax laws. Consider taking a basic tax literacy course, either online or through community programs. A small investment of time in learning the basics can yield significant financial returns, helping you identify legitimate deductions and avoid costly errors before they happen. Don't rely on hearsay or outdated advice. Second, maintain meticulous records. This cannot be stressed enough, especially for freelancers and small business owners. Keep clear, organized records of all income and expenses. Use accounting software, spreadsheets, or even simple folders for receipts. Document the business purpose of every expense. This practice not only makes tax preparation easier but also provides an indisputable defense in case of an audit. As tax expert Rachel Miller often states, if it's not written down, it didn't happen to the IRS. Third, don't hesitate to seek professional help when needed. While tax software is useful for simple returns, complex situations like starting a business, having significant investments, or experiencing major life changes warrant the expertise of a qualified tax professional. A good CPA or enrolled agent can navigate intricate tax laws, identify all applicable deductions and credits, and represent you in an audit. The fee for professional help is often a small price to pay for accuracy, peace of mind, and significant tax savings that might otherwise be missed. Fourth, review and adjust your W-4 annually. This simple act can transform your financial life, ensuring your withholding is accurate and you have access to your money throughout the year, rather than waiting for an annual refund. The IRS Tax Withholding Estimator tool on their website can guide you through this process, making it surprisingly straightforward. This puts you in control, allowing you to use your money for immediate needs, invest it, or pay down debt, rather than lending it interest-free to the government. Dispelling tax myths is more than just avoiding penalties. It's a fundamental step towards financial freedom. When you understand how taxes truly work, you regain control over your income, make smarter financial decisions, and secure your future. The human stories we've shared, of Maria, James, Alex, Sarah, and David, serve as potent reminders of the real costs of misinformation. But they also highlight the profound relief and empowerment that comes from clear understanding and proactive action. Your money, your future, are too important to leave to myth and chance.